Revenue Studio.
All right, welcome back to another episode, and I think seasonally appropriate. The guest that we have on the show today is Travis Scott, owner-operator of Scott Financial, and is definitely a decorated wealth management advisor, and probably a better way of saying it is a wealth management expert, because an expert is, so kind of cross-trained, right? Multi-disciplined in the sense of don't just fall into tax prep or the stereotypical sort of on the surface level wealth strategy. So I definitely have lots of questions, and like I said, seasonally appropriate. I know that just kind of knowing you that taxes aren't necessarily at the heart of what you do, but they are a part of it, and it is the beginning of March. So I don't know, maybe in your world, it may not be appropriate to say that we're in the heart of tax season. Maybe we're at the tail end of it, or we're in the calamity of it all. But nonetheless, Travis, thanks for being on the show. It's I know that you're going to drop some knowledge bombs. So thanks for making time for us.
No, I appreciate it. I actually thank you. I get a break from staring at a computer and cranking through tax returns. So it's actually a welcome break. So
well, we're pleased to have you. So like I said, it is it is that time of year, and for you, it's always about kind of crunching numbers. But I can only imagine that, like you said, it's a welcome break. So your clients, in the sense of wealth management, I mean, taxes becomes part of it, and I think just given that we're in that particular season, maybe we just kind of go in on that part of it. But before we started recording, you were just giving me a little bit of background knowledge. But taxes are always seasonally hyped up, right? And probably put in some cases, in some years, maybe ahead of the total spectrum of wealth management. But to you and to your clients, like where do taxes and tax strategy, like where does that fit into a lifelong journey of wealth management?
So I actually think taxes are probably one of the most important aspects, especially when you're getting into like pre-retirees and retirees that 55 to 60 range is what I would consider pre-retiree. And then retirement age is, again, anywhere between 60 and 70. In my opinion, the two biggest costs in retirement are taxes and healthcare costs. Can't really control healthcare costs. You have insurance that can help manage those, obviously. But taxes you can. And so, if you're foregoing the tax planning in a intricate fashion, you can leave money on the table, and you can cause people to get into a situation where, their biggest expense in retirement is taxes. And so why would you want to work your whole life, save all this money up, and then pay it all back in taxes? Yeah. So that's what can make it tough. And so I'm a big believer in, the reason I do tax prep, and I have through my wealth management clients, with my investment advisory firm, they have all their taxes done underneath their service fee. So they don't pay anything extra to do taxes or have their taxes done. They get a full tax plan. I also do what's called scheduled tax filing, which means I take the stress away from the April 15th deadline. Most people don't know this, but the April 15th deadline is not the deadline to file, it's the deadline to pay. Mm-hmm. And so you can forecast through planning, figure out what somebody's tax liability is. You can pay that well in advance and then say, hey, look, I'll see you in May. We'll do your taxes in May. Wow. And what I have found is that from an efficiency standpoint, I'm more efficient. And from an accuracy standpoint, I'm only touching a return one, maybe two times, which the more times you touch something, the less chance it is to be accurate, especially tax-wise. But what I find is it just takes the stress off them. So we do a full financial planning meeting. The plan, in my opinion, is a living document that gets updated annually. So we start with the initial, and then there's just iterations of it. And it's cool because I've been doing this now for almost 15 years. And so I've got clients all the way back from the beginning, and you can see the line of progression all the way through. And so, circling back to the tax aspect, we sit down, we do basically everything in one meeting: taxes, planning, and then next year.
Right.
And so people leave there and they go, man, I have next year all planned out. Now the caveat is in between, that's 365 days. If something happens, they pick up the phone.
Wow. I think that's, pretty insightful that you're able to incorporate taxes into the course of the entire year. And like you said, I think there's a huge segment of people, and at one time in my life, I was definitely guilty of this, is that you just kind of let it all boil down to Q1, beginning of Q2, and it's chaos. So what you're describing is a much more holistic and manageable approach to knowing what your tax liability is going to be throughout the year. You can plan for that on a monthly basis instead of on a quarterly sort of basis, right? Or when you're seemingly at the proverbial finish line.
Yep.
And then, like you said, take the stress out of it. And I think that most people would just look at it like they hate this time of year because it's stressful. And but it also sounds like, too, what you're saying and all of that, in that taxes are an element of your wealth management, whether it be in retirement or, like you and I, we still have lots of years left ahead of us here in our professional careers. It's an element that you can control. So, and if you can control it, what I'm hearing is that it may empower you to keep more of your money and perhaps give away less of it. What's your idea there? I hear the saying that it's not about how much you make, it's about how much you keep. Where does, in terms of that theory, what's your subscription level or what's your buy-in level to that sort of statement?
So, man, I call it influencer accounting. You get on YouTube and you see these guys, they're out there, they're just, they're doing cost segregation studies and short-term rentals and, to buy a vehicle every year and depreciate it, and that sounds great, especially if they are a tax prep company, because they're going to get high value clients because it's sexy. Right. What they don't tell you is, one, that you can only do most of that stuff 1 year. It's not like a continuation of going down the road. And two, when you look at the actual, if you put an ROI, a return on investment, on something like that, which you can absolutely do, if you have a tax return, tax planning, and then couple that into hey, here's how much money we have saved you, and then that earned X, right? So if you do that, the math I shouldn't say never, very rarely works out. I'll give you an example, right? So let's say, you have you're self-employed, right? Which you are. And at the end of the year, you have $100,000 in net income. So that's what's going to be taxable, okay? You have two options. One, you're going to pay the tax. So let's say it's a 20% tax bracket. You pay 20 grand, you keep 80. Okay. On the other hand, you go to a guy and he says, go buy a $50,000 vehicle. I'll save you 15 grand in taxes. And you go, dang, I want to keep 15 grand. Why would you not? So let's run through the math, right? So you start with 100, you buy a $50,000 vehicle. So now you're at 50K. Okay. So at that point, the tax on that is $5,000 because it's going to go down to the 10% bracket.
Sure.
Right. So you save $15,000. How much money you got left over?
Not 20,000.
No, it's 45. So why would you spend 55 to save 15? Why don't you just keep 80 and pay 20? And then, so then you take that and you extrapolate that over 10 years. Who's got the higher bank account?
All right. So now we're compounding.
Yeah.
Right.
So, I always tell people, look, and when it comes to saving money, and I have a little bit of a coaching program. It's not anything worth, I feel so bad with the younger generation. And I look at these kids and they've got 4 or 5 checking accounts, 2 savings accounts, 5 credit cards. They have all this stuff. And I tell them, I'm like, look, your goal when it comes to investing is to get one account to 100 grand. That's the hardest dollar figure to get to. Why? Because it takes so long to double your money to get there. Right. So if you had to guess, how many times do you think it takes you to double your money to get to 100 grand?
In the traditional sense, I don't even know.
It's around 17.
Wow.
17 times to double your money. Now here's the question. How many times does it take you to double your money from 100 grand to $1 million?
I don't know. That's what we hire you for, Trav.
It's like 4.5.
Okay.
So the hardest is to get to 100 grand. Once you get to 100 grand, money makes money. So the more money that you can have sitting in an account, the more it's going to earn you.
Sure.
And if you take returns and you put the same return against it, again, it's easy math. What's 10% of 100 grand? Well, it's 10 grand. What's 10% of 10 grand?
Right.
Well, it's 1,000. Well, next year, that's 110,000 on 10. It's only 11,000 on 10. You know what I mean? So, when you get back to the tax aspect, the biggest thing I see from small business owners that I think that they fail in is they worry too much about what they're paying in taxes and not what they're paying themselves. And so they would rather spend more money buying stuff that they don't realistically need, that doesn't necessarily add value to their business. just to not pay the government. But when you look at it on the forward thinking, it's like, man, you guys are just spending money to save a little bit versus you could pay your due. The tax guy's always going to get his due. And then you can turn around and put that money in your pocket. I mean, people that own their own business, they have to understand that the reason you have an LLC and you have these different tax entities is because it's separate than your personal stuff. So keep it separate.
Right.
Use that as if you switch your mindset and you have a business and your business makes money, think of it as a machine that prints money. So if you put $1 into a machine and he gave you 10 back, how much money would you put into it?
Oh, I'd borrow a lot of money to put
all
in that
of
machine.
it.
Right.
All of it. It would all go into that, right? Well, that's what a business is.
Sure.
And so why in the world would you want to put $1 in and it gives you $10 back, but then spend it so where you only get $5 back because you had to spend it now to pay taxes?
Right.
It doesn't make any sense. So that's the biggest thing I see is, and I don't work enough with small businesses in this area yet. It is something I am focusing on. But man, if they put the focus on how much money they can use their business to put in their own pocket versus how much they can save on taxes, that you always get ahead.
So Travis is essentially saying for us here is that all of the sensationalized short form social media content of small business owners going out and getting themselves an exotic car or a G-Wagon or something to that effect is perhaps not the most sage or sound financial advice for a small business owner. There are other ways, and we see it all the time, right? We see people giving advice on basically they're countering everything that you're saying about going and purchasing liabilities. But I think that you pretty much just blew cannonball size holes in that plan, and in such a way too that's pretty easy to wrap your head around, right? I mean, if you're going to make a large purchase to I guess in a sense, effectively reduce your tax burden. But if that becomes a liability and it's not something that's making you money, then what are you really doing, right?
Yeah.
I mean, you're not tipping the scales in your favor long term.
No, and again, it depends on. I mean, again, if you got like a shipping company and they need to go, I'll use roofing, right? If you got a roofing company and if they add one truck and it adds $100,000 to their bottom line, that's not a liability, it's an asset. Yeah, you get the depreciation and you get the tax savings doing that, but doing that adds value, right? If you just need to save, money on taxes, so you're going to spend it, you're not, especially buying a vehicle, because man, that's just, as soon as you turn the key on in that parking lot,
it's costing you money.
Yeah. And it never recuperates, right? Even if you, you look at even like, for folks out there that know Grant Cardone, like the reason Grant Cardone can do what Grant Cardone does is because he's in the industry that allows the most flexibility to do that stuff. And so what he says is true. I know he's been audited a handful of times and I know he's passed with flying colors, which a guy in that circumstance you should. But for most folks, I'm going to say the ordinary American, that stuff just doesn't apply to you.
Sure.
It just doesn't. I mean, it's very rare. I've got the opportunity in my career to work with people on the Forbes list, professional athletes, actors and actresses, and I'm here to tell you, not a single one of them is doing that. They care more about how they can use their money to earn them money than they do about relatively, well, at least paying taxes for their generation. The next, and this is way outside of the scope here, but the next is where you save on taxes is passing it down through generations. That can be, there's a whole different book to.
There's a whole strategy in of itself.
Yeah, that's a whole different, then you're talking laws that change all the time. And so that's a whole different hole to climb down. But at least from a standard filing your taxes, and especially if you're a W-2 employee, like if you're trying to come up with ways to I'm going to buy a short-term rental to take the depreciation because I can offset W-2 income. It's like, so wait a second here. You're going to go buy something that costs $300,000 to save $20,000 that is otherwise going to cause you money because you're going to have management fees and you're going to have real estate taxes. And yeah, you can have the person who's renting it pay it, right? You don't have a payment, but you're still not going to get ahead at the end of the day.
Right.
Unless you're, again, if you want real estate as a portfolio, which by the way, I don't think now's the great time to do that, but if you want real estate as a portfolio, then sure, go out and buy the real estate, get the apartment buildings and get the rental houses and stuff that you want. All for that. But if you're using it as a tax strategy, that's silly. If you do it as an asset class in your investment portfolio, all for it, right? Because you're trying to maximize a return. If you're just doing it to save money on taxes, like you're just throwing your money away.
I love it. So, and it is controversial in the sense that there are so many, influencers or people that are attempting to be influential. But what you're doing here is not only, I mean, it's the advice that you're giving and how you're going about it for me is influential, and it's at a very informative level too, right? So you kind of feel like you're tiptoeing that balance, pretty handsomely. But it is controversial in the sense that there's so many other thought leaders out there that would think and advise
Argue against
the opposite. Yeah, argue against it. But and guys like Grant Cardone are just, that's so sensationalized. Like that guy's buying jets, but even when, I see his reels about buying a jet, it's just like, can I do it? Yeah. Should you do it? No. I mean, it's going to cost you.
Yeah.
And
Dude, oh man,
oh my gosh.
I know all the flying private is talk about being in the wrong industry. Seeing what it costs to buy private planes and then to maintain private planes and then to fly private planes. Like you think when you're at that level, what you're buying is comfort. You're not saving money from a tax standpoint. You're not doing anything there too. You're just at this point going, I just don't want to go to the airport and go through TSA.
Right. I would say you're buying, a lot of those people are probably buying time too, right?
Sure. So, I mean, time, you're 100% correct there. Yeah. Time is absolutely on their side there as well. 100%. But yeah, I mean, those for the average, what I'm going to say, middle to upper middle class American, I mean, doing that kind of stuff, if you're doing it for just that standpoint, I don't think it's worth having or worth doing in the long run.
Yeah. So I mean, and to your point, then speaking to the average, middle to upper class American, somebody that's likely never going to fly private in their life unless it's just like a bucket list kind of experience, and that one-way $12,000 trip to from Baltimore to Orlando. It's just going to be like if you want to lose,
it's great. It's fun to do. It is. I've had the privilege of doing so a couple of times. It is awesome, but yeah,
there's other ways of doing it. So in terms of specifically going back to buying time. We can do that on, a much more relative and relatable level, right? Where we can buy time, not necessarily in the sense of flying private, but we can buy time with timely investments. So, in your investment advisory firm, what's, typically like, what's the 101 thing? Like you get somebody that comes in that's, I would say that if I had to guess anyway, I'd guess that your clientele probably starts at the earliest, like in the mid to low 30s at the earliest. I'm guessing you're probably working with folks that are just kind of wrapping their head around.
Yeah. So most of those are coaching clients for those folks. And they really kind of reach out with like one-off, like, hey, I want to buy a house. How much can I afford? Or, hey, I have hundreds of $1,000s of debt. How do I get out of it? So those are the folks there that, handle coaching wise, mainly from an investment advisory standpoint, like my investment clients. The average age is usually around 60.
Okay.
So again, you're in that retiree stage. And really what they're looking for is they've got a 401k, typically husband, spouse. They got a 401k and they're getting ready to retire. So what I see often is just out of bounds allocations through that, which may have worked, when they were younger, but they're getting to that point. So why take the risk? Mm-hmm. The other thing that's scary too with 401k investing, and this is going to become, in my opinion, not that I try and predict what markets are going to do or anything, but, for a little while now, what you're seeing is something that's never really been seen, which is you have stocks and bonds moving together. And so traditionally, bonds used to be the safe haven, right? So if markets went down, bonds went up, they were inverse of one another. Bonds are considered safe because you're buying debt of a company. They're paying you an interest. They're basically, they got a loan to you. And as long as they don't go out of business, you get your money back. And so your return is whatever that interest was. What's interesting now is that you're seeing stocks and bonds go up and down together. Maybe not 1-to-1 ratio, but that's scary because then you don't have the protection. So if you look inside a traditional 401k allocation of the options that people have available to them, they really don't have any sort of asset classes that move independent of now both stocks and bonds. So just some examples, real estate's one. Again, I'm not super bullish on real estate at this point. I think there's a lot of, underlying stuff there. But I mean, you have, real estate, commodities, commodities can be considered a risky-esque asset class, but it's an asset class that in and of itself doesn't necessarily correlate with stocks and bonds. You can have preferreds, you preferred shares of companies, you can have crypto. People can say what they want about crypto. I think crypto's here to stay. If you look at crypto as an asset class versus, the traditional, I'm going to get rich tomorrow, then it can be super powerful within a portfolio because it's a mainstay and it's tax friendly. You buy it, you don't sell it, you don't pay taxes on it, right? And it's also a currency. So if in time they need to purchase something and wouldn't otherwise need to, cash transaction wise can be messy fee wise, you have crypto that you can just buy it.
Interesting.
Yeah. And so crypto, I think, is an asset class that doesn't get talked. It gets hated on a lot because it's crypto. And I think it's one of those things where it got a bad rap early on. And but I think it's a mainstay.
People are scared of it is what I sense.
And I don't think people necessarily understand it. I mean, then you get into blockchain and I mean, even from an expert knowledge level, I don't understand it. From an asset level, when you look at diversification, the textbook diversification is basically what moves with the market, and so, you have correlation. And so the higher you're correlated with the market, the less diversified you are. So in my opinion, I diversify based on asset classes, not holdings. So before the definition was if you own the S&P, you were technically considered diversified. Well, the S&P 500 is the 500 top companies, that are listed on the S&P. Over the last decade, there's been 7 that moved that whole indice. Now, guess what? Those 7, they're the draggers this year. You're having breadth rotate back into the market where you have Google, NVIDIA, Microsoft, Facebook. They're all not doing well. And why? Well, AI,
Sure.
which we can talk about then too. But so anyway, so like the investment 101 stuff, I'm a big believer in diversifying across asset classes. I look to find assets classes that don't have a ton of, from a risk standpoint, they can be sometimes volatile, but when coupled with the other asset classes within the portfolio can more, instead of going up and down very steeply, the portfolio in itself just goes very
stable.
Yeah. The other thing is I'm a big believer in yield, and that can be on the controversy because yield is in most cases taxable. So depending on the asset mix of the client, you could have adverse tax consequences. But I mean, man, if you got somebody that's got $1 million and it's like, hey, I can guarantee, no, I shouldn't say guarantee, but this portfolio as of right now has a yield of 5%, which means it doesn't matter what the market does, you're going to get 50K. It's hard to say no to.
Sure. You
know what I mean? And so when you're in retirement and you can say, hey, look, this thing here will pay you 50 grand. It doesn't matter if the market goes all the way to zero, which that's a exaggeration, but it doesn't matter necessarily the ups and downs. That's what it's guaranteed to pay you. Like that's a pretty safe bet. Sure. And then you add social and a pension on top of that. Those people are set. They can turn off the TV. It doesn't matter.
Right.
I mean,
that's an interesting way of putting it. Is you can just kind of tune out from what's happening in society if you have a good plan set in place and you have some guarantees, which are, I mean, guarantees, there is no such thing as a guarantee. But if you have some very predictable and sustainable options configured for you, then that gives you a lot of peace of mind. Yeah. I'm curious, in all of this, because obviously your knowledge is superior and it's at that expert level. And sometimes in conversations like this, I try not to kind of glaze over because like my knowledge is at an infant stage by comparison. So, and I think that is likely true for people that are watching and listening to some degree. And I'm just curious, working with someone like you, and I mean, you obviously have some sound and very sage sort of ways of going about diversifying, or not in some cases. How does that compare to working with, for lack of knowing all the other firms that are out there that are big, but like, how does that differ from working with like the Edward Joneses of the world and the Transamerica, or like some of these T. Rowe Price? Where do you differentiate yourself amongst these Goliaths seemingly in the market that are offering wealth management advice as well?
Yeah, great question. So there's really a lot to unpack there too. So really, in the financial advising / wealth management world, there's technically what I'm going to say 3 pathways, but from an investment management standpoint, there's really 2. So you have what is called an investment manager or investment advisor. That is a different license category. You have to pass a test to be considered that, right? That's what I have. It's the FINRA Series 65. It's the investment advisor, series license. And then you have, on the other side of the coin, a broker. And they have different tests to pass then as well. And so the difference between the two is that the investment advisor, typically, when they're a fiduciary, and what a fiduciary is in layman's terms, is I have to have your best interest at heart. Okay. So I can't, not deceive's not the right word, but I can't do something and make a decision on your behalf because of some additional resource that I may know that I don't need to tell you. And I'm not saying that brokers do that, but the difference is I'm a fee-only advisor. When you go and you cross the aisle to a broker, which, and you can do a hybrid method too. There's hybrid, like Edward Jones they're known for being like a hybrid model. Same with the big ones. Why? Because they kind of get to play in both sandboxes.
Sure.
But when you're on the broker side, they get paid differently. They get paid by selling investment products. And so you have like the T. Rowe Prices and the Edward Joneses, those groups of the world, they all have their own funds. And so when they buy into the fund, that company, the parent investment company, makes money.
Okay.
And then, so the advisor is they can become incentivized to buy something for you that may or may not be, conducive to your situation, right? Not saying it's going to lose money, but there could be the same investment fund. One pays 1% fee that the advisor keeps a commission on. The other pays 5 basis points, And so that comes out of your pocket,
Gotcha.
Right? And so that's the difference. Now on my end, like I charge an asset under management fee. So I take the investable assets that you have, there's a fee associated with that, and then that covers it. So there's no performance knock. So basically, if you think of it like this, if you have a portfolio, I'll go back to the 5% yield one. If you have a $1 million portfolio that yields 5%, you're going to pay me less than 1 to manage that, and then everything else. Versus if you have a broker and that broker invests that $1 million, there could be 10, 15, 20 different funds in there. Each one can have its own fee structure to it.
Okay.
And so that's where you have the difference is when you're actually trying to figure out and calculate fee-wise, it can be somewhat difficult to calculate that because a lot of that's on the back end performance-wise. Also, a lot of it is how long it's held, whether there's sales charge and load fees. So the actual what the person is paying that advisor can be, a bit hard to quantify. And they don't know. Me, I am very transparent fee-wise. Before we sign anything, this is what it's going to be.
So you make it simple in the sense that as a client coming in, I already know what I'm going to pay you based on the caliber, the quantity of assets under management, right? So the whatever that dollar amount is, assets under management, you anchor your fee to that. It's set. So we all know it's not it's not a sliding scale.
And so I bill quarterly in arrears, which means I have to perform a service before I send you a bill, and you get a typical invoice, and that comes out before, so exactly what the fee is going to be. The other nice part too is you can kind of see what the portfolio made, and then you can see what the fee is, and you can be like, my assets paid for it. Like it didn't come out of my pocket.
Sure,
it came out from the appreciation of the assets, and so
which makes it. Sorry to cut you off, but that kind of makes it like it's performance based in a sense too, right? I mean, what you're paying going in, but like if you're saying that if you can see assets are growing or shrinking, right? Because like you said, there is volatility. So there will be times of growth and sometimes where you take a step back, but that's your fee is kind of anchored to both, right? So I feel like that makes sense. It's performance in a way, but it's like it's transparent and
and so what it comes down to, like if you have, because again, when you get people in retirement, right? So they're pulling money out of their assets. And so, for me, I'm a big believer in, I had to go through this one situation early in my career where, you had fees set by another advisor and the one person had more money than the other person and was paying less than his buddy. And you get two people in retirement and they like to talk about everything. And so you have to sit down and have this conversation of like, hey, my buddy over there has more money than me and pays less than I do. What the heck's the deal? So I try and avoid that. So I have mine, again, it's on a percentage base. And so if I do a bad job, I make less. If you pull money out, again, I'm not here to increase, because that becomes again, it's real dollar amounts. And so, I think I am by no means the cheapest guy. I don't consider myself a premium fee, but I'm above market.
Right.
And so, and what I provide with that, with that fee is that you get I call it the family office model. And so I have two lines where you can select from, in my investment management. I have the asset under fee model, which I call it the family office model. And that gets you every single service underneath the sun. So most people, right, think about it, and you can probably put yourself in this situation too. Most people, they have somebody that manages their investments, or they do it themselves. They pay somebody to do their taxes. They do it themselves, right? Or they pay a software. If you're at the estate level where you need estate planning or documents, you're paying a lawyer. You have real estate wise, when it comes to real estate transactions, I am by no means a realtor, but I have partnerships in with mortgage brokers and realtors where we get to, play nice and help one another out. Same thing with lawyers. But you have all these insurance-wise, you either have somebody, especially people outside of the workforce, they have to either go to the marketplace or go on Medicare. The transition to Medicare, that's hilarious to watch people just lose their minds over too, because it's not difficult by any stretch of the imagination. I'd never be able to do it if I didn't know how to do it. But most people have all these people, right? And so what I offer and what I bring is you get one guy and he can do it all.
Right.
And you pay one fee.
Right.
I'm not nickel and diming you for calling me. You can call me anytime you want to. I work every weekend, I love the Saturday, Sunday meetings because it's outside of my normal hustle and bustle. So I'm not burnout going into a meeting. But you get that resource. And then on the other side, for people that aren't quite at that, not level yet, but aren't they kind of want to still do the DIY thing, which you have during bull markets. When the market's going up, everybody thinks that they're an investment professional. All it takes is some turmoil in the market and then your phone just starts ringing. And I think every financial advisor is like that.
Sure.
And so for those people, it's a planning only package. And so there's no investment management. I'll sit down and provide thoughts. It's just a fixed fee. The fee depends on what they want in the plan. If it's just basically investment wise, it's lower. If they want the full gambit, it's higher. Again, not trying to gouge anybody. That engagement is shorter. It's usually around, I don't put a time limit on it, but it's usually around 90 days, start to finish. And then if they want any other services, then they can choose to, I give a discount. They can choose to pay that. But that way, it kind of gives both people, on whatever, how should I say, whatever area and time that they're in. You get people that get into retirement and they're like, oh, I can do this investing stuff. I manage my 401k the whole time, and then all of a sudden, then they're taking distributions and their accounts going down. And then, man, you have a day where the market drops 5% and they get whacked. And it's like,
right.
And they're calling you up. So
all of a sudden, they're not the do-it-yourself expert that they perceive to themselves to be.
I probably should have started with this, but so the secret to investing, right, is to set it and forget it. Especially for younger folks. Set it and forget it. Now, when you get to a certain point, then you need to start checking in and managing it, and reducing risk. And again, it's hard to reduce risk these days a lot of the times within the 401k landscape because there's just not the flexibility with options. to truly diversify. At least from my opinion of a diversification. Again, over the long term, I think you're fine. But so anyway, so that's kind of how, and I got that model, really. So that's my where I was at prior-wise. We worked with a ton of ultra high net worth people. And that's what, they use that model. They want one person, they pick up the phone and they ask a question, and then that person has to go call whoever and do whatever to get them the answer. Because if not, they're calling, these people have hundreds of accounts with dozens of people and 4 different attorneys. And so they're not going to spend the time to do that. They want one person to be that person. I took that model that was way up here and then tried to condense it down to be one that everybody can use.
Yeah. And I think that everybody wants that white glove approach to really kind of any service in life where you just have the guy, right? Like you mentioned roofing earlier, like you want to just have the roofer and like the HVAC guy. And in your realm, you want to have the guy on the money line, right? You just want to be able to call one guy and say, hey, this is where we're at in life. We have a big purchase decision coming up. Like, can we swing it? And if we do it, how should we do it?
Yeah. What's going to be the tax impact? How does that impact living down the road?
Yeah.
Well, the litany of questions and scenarios goes on. And so that's what makes it nice. Because in today's, again, if you're with like an Edward Jones or T. Rowe Price or anybody like you mentioned, even if they offer the planning, which I know most do, and I'm not saying the planning's not adequate by any stretch of the imagination, but it's all templated and structured. And so one plan's going to look fairly similar to the next plan, which is going to look fairly similar to the next. The numbers are going to be different, and there's going to be some different variables. But for the most part, it's all relatively the same across the board per client.
Right.
And without them, and then from there, so then you need to go get your taxes done. And the guy at T. Rowe Price or Edward Jones, he didn't talk to the guy over here that's doing your, ABC tax firm.
Right.
And so, if you're trying to do, and again, I'm not tremendous fans of this stuff, but if you're trying to do Roth conversions or, let's say you've got, you get paid out in, company stock as a wage, or you get big commission checks, there's things you can do tax-wise while you're still working that will save you money on taxes, but also provide for a higher, return on investment.
Sure.
And if those two ain't talking, if you don't give the plan to that guy and that guy doesn't call the advisor and you guys connect the dots,
right,
ball gets dropped. There's a disconnect in the middle.
Sure. And then ultimately the client is kind of the harm party in the middle. So what you're saying is that you've taken the hassle and the kind of canned nature of, the corporate wealth management firms that are scaling, right? And they have to have systems and processes in place. And I don't think either of us would sit here and knock that. I think we can appreciate and respect the magnitude of their success. But in order to do it at scale, some things just need to be very much the same. And what you're able to do and offer that they're not is that you're really combining the entire spectrum of not only wealth management, but also bringing that family atmosphere that you're not going to get at corporate America and connecting it to all of the other facets of money and the management of money, from taxes to planning in terms of wealth and growth and playing the compound interest game, right? So all of that. So I think that's amazing. And I could sense that. It feels obvious when you ask, a solopreneur, in the sense like what makes you different than, the big box guys. But, hearing it from you and disclaimer too, you and I, we, 20 years ago, we used to wrestle and, I know that, you're a committed guy, and we went through those sort of seasons together, but now, 20 years down the road, our paths have reconnected, and, I can still feel that same level of discipline that you applied on the wrestling mat. Now you're giving that and all that effort, right? It's, I think it takes a high level of discipline to be able to provide a compact and comprehensive service like that for folks. So what I'm curious too, so you mentioned that you work with a lot of retirees or folks that are getting ready to enter into that retiree stage of life. Are we starting to go into, are you noticing that we're starting to slip into an era where there are more folks that have less time invested into the traditional employee savings plan, the 401k, because there are less folks that are staying in employed by one employer longer? Like, what effect is that having on folks that are saving for retirement if they have multiple entries on their resume. Like, how is that impacting their retirement?
So that can be, it depends. It depends on typically the company that they used to or had worked for. A lot of companies, like if you're with like Empower or Principal, Fidelity, if you leave a job, they sometimes give you the ability to open an IRA, which is an individual retirement account, in your name, and that can be automatically rolled into it. And so what I see one of two things. I either see somebody that's got 5 or 6 little tiny 401k accounts that are hanging out there, or small IRA accounts that were set up. The detriment there is typically nobody's looked at them in 20 years and they sat in cash. And so they you can say what you want to about, like, inflation's real. Everybody knows it's real now. Before it was a made up term. Now it's real. Say lost money. Other times what you have is, and the other downside to that too is like I mentioned earlier, money makes money, right? And so the compounding of that, even though, depending on what the overall return for all those would be, the compounding aspect of it is one thing too. And it's just discombobulated. You have just a bunch of stuff. I had this. I'll tell you a funny story about that because I think it was a great moment. One I'll never forget, but it touches on this. The other side of the coin is that you have somebody that either had worked with an advisor or had an advisor or knew that they could roll stuff into it. And so you either have one or two, IRAs or 401ks that are out there. So it's really just making sure that you nail down, where somebody, like what somebody used to work for.
Okay.
And then try and find the paperwork and get into the portals
and keep reinvesting it so that way it doesn't end up in 5 accounts spread out.
Yeah. So what you would do is you basically consolidate it. So you would roll it all into one account underneath their name, and then everything's underneath one account that it has their name on it. So that's the typical, you have people, especially like our generation too, jumping around. And again, I'm such a big proponent on people keeping their stuff in one account, so like I've turned down dozens and dozens and dozens of people who have called and are like, hey, I left my job. I've got 40 grand in a 401k. Can you manage it? And I'm like, are you working now? Yeah. Do you have a 401k plan where you work out now? Yeah. Roll it into that. And then you just keep going.
Right.
The other thing is too, with that is you get dollar cost averaging, which I'm a tremendous fan of. Dollar cost averaging is it's every time you get a contribution into your 401k, that's what dollar cost averaging is. What it does is if you're investing the same amount of dollars into the same amount of things, then you will buy less of it when it's higher and you'll buy more of it when it's lower. So the end game is you're technically buying lower and selling higher, which gives you a gain. Sure. That's the education behind it. And again, huge proponent of that. That's how you build wealth. So, but anyway, so funny story about that. I was working with, this was, probably 10 years ago now. I was working with a family and, they were going through their, their retirement stuff. And she's telling me, she's like, I spent 20 years at this company and then it got bought out and this is all I have now. And not that it wasn't a lot, but it was something that, I'm like, man, you spent 20 years at a company, which was, technically over the time span was 40 years. She started there when she was like 21 or 20 or whatever. And it's like, so this thing's been sitting in an account for 40 years. You haven't seen it or touched it in 20 or didn't even know, that it existed. So come to find out, we went through, did we go through, I think we went through Paddle. We went through a website and ended up locating where the old administrator was. The administrator now was Voya. Before it was ING. It was now owned by Voya. Ended up being over $500,000.
Wow.
That she didn't know she had.
Wow.
Yep.
Yeah, well, that's you turn the mattress over and $500,000. That'll put a smile on anybody's face.
Oh yeah, she started crying. That was I remember when we got the account to log in. Well, we had to set one up, and everything's linked with your social. And she had me on the computer, because she wasn't obviously very good with computers, and she had me go in there, and that account popped up, and I was like, oh my god. And she's like, is it enough?
Is it all gone? Yeah.
And so I just turned her little laptop around, and she just went, oh my gosh, and then just hysterical crying.
Yeah, that's amazing.
Yeah.
Yeah, I imagine that most of your clients would love it if you would just find
Oh,
500,000 for them.
I've that's the highest. I've had two separate occasions where I found 180 grand. Matter of fact, last year. Now she knew she had the account, but didn't know what was in it and didn't know how to get into it.
Sure.
And then that turned out to be that. And then I had another one that was around 100 grand too. Same thing. They had the same address sent for whatever reason to 4 addresses ago.
Mm.
And he ended up somehow or another, the statement ended up coming to him. He's like, I don't think this is me.
Oh, wow.
Yeah.
Wow.
I was like, yeah.
So you're able to confirm that it was.
Yeah. I mean, it had a statement with his name and, basically they forwarded it to him. So it had his name and old address on it. And he's like, I don't remember any of this. Like, I don't know where this money came from. And I said, well, we're going to log in and see if we can't, because now with the portals and stuff, they match it to your social and date of birth. And sure enough, man, we created the username and password and bada bing.
There you go.
Right in there we went.
100,000. So what I'm hearing is that going back to what you were saying about the small office and the kind of that family atmosphere approach is to get the guy early. Like in your case, is to get you early, even if it's just planning. But if you're having that conversation where at least you're looking and you're aware of, if you are a job, I don't say call it job hopper, but if your career it evolves and it leads you from one employer to another, having someone like you at their disposal, or say at my disposal, that'll help insulate me from, potentially losing track of $500,000 that is then over, like you said, for that particular case over the course of 20 years. I mean, unfortunately, it wasn't benefiting from, the compounding effect of reinvestment, but in fact, it was suffering potentially from inflation, right? If it became cash, then it wasn't growing. And if it's not growing, then it's, what we always say in life, right? If you're not growing, you're being eliminated. So same thing. So, the one thing that I hear from you more than anything else is, although you are chatting with retirees and those that are planning for retirement stage more often than anyone else, is that, if you really do want to take your lifelong journey of wealth management and financial literacy, if you want to take that seriously, it's to get the guy early, even if that is just kind of like, checkups like you would do with your
physician. I mean, so for younger folks, I'm a big believer in getting out of debt, and I've changed my ways in that, just from a personal standpoint. You don't see, especially in I'm gonna say our age, probably if you bought a house in the last 5 to 6 years, you got a pretty sexy interest rate somewhere 3.5% and below. I was a big believer in you can arbitrage that, right? Market does 10 on average. You're going to arbitrage to 7%. Don't pay it off. I've changed my tune on that. I think, man, you want your personal wealth to explode, stop paying on stuff.
Yeah.
I mean, it's one of those things. I look at it. I had a conversation with the guy, and in a great position, him and his wife both, great position. I wouldn't say they make a ton of money, but they're very frugal. 2 kids, and the only debt they have is their house, and their mortgage payment's like $1,000 a month. And I'm like, dude, start going to town on it. And he's like, well, I can afford this for the next 100 years.
Right.
And I said, okay, let's do the math on that. Right. So $1,000 a month, that's 12 grand a year. 100 years, that's 1.2 million. That's without a return. Mm-hmm. You put a 10% return on that. What is that? 5 mil?
Right.
What would you rather do? Pay 1.2 mil or have 5 mil?
Right.
Again, when you look at the ROI over the long term, I'm a big believer, and I see this in retirement. Cash flow is king. All right. So, the definition, my definition of retirement is whatever you were, when your assets can provide you with a paycheck that either matches or exceeds the paycheck that you're customly, you're getting now, by definition, you can retire.
Sure.
Now, you have the optionality of, let's say your paycheck in retirement won't do that. Okay, well, do you have a car payment? Do you have a credit card payment? What's your mortgage payment? So if you get rid of all that, well, then does your paycheck cover it now? Oh, guess what? Now you can retire. And so, again, I wasn't, Dave Ramsey gets a ton of slack. And I used to give Dave Ramsey not a ton of slack, because what Dave Ramsey, I preach a lot of the same stuff. Like, you want to get out of debt, doing the snowball method is, in my opinion, by far the best method. If you have savings built up and you have a little bit of debt and savings covers it, pay it off. That savings comes back twice as fast. right? So, the same thing goes with a house. If you're in a position where the only debt you have is the mortgage and you don't need a new car and your family's in, a financially secure position, you don't have to attack it to where you're spending every last penny on every last paycheck to pay the mortgage down. Just start with either make an extra payment a quarter.
Okay.
You get a bonus a month, take half of it, put it towards the mortgage. And what you'll find is that because you do that, every payment you make after that, it just amplifies the payoff. And so you can take something, even by making one extra mortgage payment a year. If you have a 30-year mortgage, I think it takes like 7 years off.
Wow.
And people don't think a lot like, oh, well, it's just 7 years. It's like, yeah, but now you're down to almost a 20-year mortgage. Like the interest you save on that alone.
Yeah.
So okay, so make 2 payments.
Right.
Make 2 extra ones. Well, now you're down 14 years. So now you're at a 15-year mortgage, but you got a payment that's only super affordable.
Makes perfect sense to me, right? Is to pay down your liabilities, right,
Yeah.
or reduce them to the point where you just don't have them anymore. So I hear what you're saying. I work with some folks that are they have varying opinions on the Dave Ramsey deal, but I think that there is value in eliminating debt and
yeah, his principal foundations I think are hard to argue against. And again, his target market is for people that are struggling financially. I would say you get into like just above that, those people tend to be the ones that poop on him all the time. And that's probably because they don't need to do the stuff that he's done.
Sure. Yeah. I think it tends to be a little bit radical, or it could be for some folks. Again, you mentioned Grant Cardone in the beginning. So some of this out there is a little bit radical. It doesn't apply to everyone. But, kind of in summary and in closing, I know that you had mentioned that, what you provide and how you do it, working with folks that in a local setting, we're here in the, York and Adams County, for you, ideally, who are you looking to, and for folks that are listening and watching, perhaps they can qualify themselves for you. I mean, who ideally are you looking to attract, and who do you feel that you have you can give the most bang for their buck, or who are you most impactful for? So
really, in terms of what the family office model, the concierge white glove model, asset under management fee, those folks, again, pre-retiree to retiree, the pre-retiree, maybe not so much initially, just because typically their assets are still included in their employer plans. A lot of those folks are on just a planning only deal. And usually I'm not a big meeting a bunch of times during the year. And I know that can kind of go against like, oh, you're not servicing your clients. It's just if you change things too much, what's the point of doing a plan if you're not going to stick to it? And so if you change it 2, 3, 4 times a year, like you're just not doing a good job planning.
Sure.
Right. So, and changing stuff too much can be, in my opinion, a bigger detriment than setting it and forgetting it. Not that I'm a big proponent of that, but from a plan standpoint, a lot of the times it's a fluid document, and unless somebody has major life changes or events, typically speaking, there's not a ton of changing that's going on outside of like taxes and insurance and that kind of stuff. But ideal wise, again, it's pre-retiree, retiree. I call my mattress millionaires. It doesn't mean you have to have $1 million in assets. The people that really benefit, and the people that I believe, even if it's not me, people that should go talk to an investment professional, you get above the $1.5 million to $2 million in assets. There's just it opens you up to a different environment from an investment standpoint. And that can be very, very important for you long term, especially like if you're talking the next generation. Not saying you can't experience the same stuff below that. Typically for people in that regard, if you got a 401k with $1 million in it, you need to go talk to somebody. Yeah. Not saying you can't do it on your own, but man, you have a year where you're down 15%. I mean, that's a massive impact, especially if you're taking a withdrawal rate, because the withdrawal rates in retirement are super important. You could blow yourself up easily over the long term to where you never recover.
Right.
And so, those folks need to, again, go talk to somebody or work with somebody. For the folks, my ideal clients, the clients that, love me retention wise. I have clients now that are, when I started. They love it because they can set it and forget it.
Sure.
They don't have any fears of sleeping at night over insurance, over investments, over having money to live. They get a paycheck every month like they did when they were working. Their taxes are taken care of. Hey, Trev, I need money to send to my kids. Here you go.
Yeah.
Or hey, Trev, I'm going on a trip. Here you go.
Yeah.
We get together. I'm a big in-person guy. I like to travel too, so I typically go to clients. I don't do a ton of in-meeting or Zoom meetings. I'd like to I'll get on an airplane and come see you. So, but those are the people that I think I serve the best. For people that are looking for DIY stuff, I can do the planning for you. Those conversations from an investment standpoint tend to turn into like their investment theory versus mine, and their investment theory is typically backed by like the influencer type stuff of doing different things. And that's totally fine. I'm not saying that stuff doesn't work, but again, when you're looking at something from a holistic top-down view, and you see somebody's life and you see the spider web that, attaches to everything, then, the planning aspect of, them handling their own stuff is, limited in scope. And that's why, again, I limit it in scope.
Sure.
It's a shorter-esque engagement. It's mainly, and it's very tax focused. Most meetings anyway.
Yeah.
They want to know, I put together a portfolio report for them so they can kind of see where they're at. The same recommendations are typically always of like, hey, look, you're not diversified, sure. Unfortunately. I mean, you can't be 68 years old and be 70% in the stock market, especially now, because, you're having a major rotation that is starting to hit the airwaves. It's been happening for a little while, and it's probably about last November. It's when I think it truly kicked off. And so you're seeing something that hasn't really happened in like 8, 9, 10 years. Gotcha. And so you have people who didn't think about the market that had stuff in a 401k plan when they were working and it was on autopilot, and then now they want to manage it, and it's a totally different landscape.
Wow. Well, Travis, it's clear that for folks that are looking to maximize their retirement, you're obviously the local authority on that, and I can feel it that you're looking to bring that family atmosphere. So definitely appreciate you being on the show, carving out time for us. I've definitely learned a lot. For those that are listening and watching, we'll make sure to link all of your contact information below. And, personally for me, what's really resonated and what's really rung out is that regardless of the stage of investment that you're in, is that it's likely the best thing to do is if you're just not sure. And if a lot of the things that we were talking about felt very high level, talk to somebody like Travis, yep. Find someone that, is going to bring that deep interpersonal approach to your life and your finances. That way you can plan early, plan smart, and then stick to the plan over the long term. So that way you benefit, you realize the max potential of that plan over the course of all those years. So Travis, thanks for just dropping some knowledge bombs on us. I definitely feel like I can go out now and exercise some of that terminology in a conversation. So, but everything that you provided us here today, I think it was sound advice, sage advice, and clearly you're the local authority. So thanks for carving time out for us.
No, I appreciate it. I thank you for the mental break.
You're welcome. All right. That's a wrap here. So that was Travis Scott from Scott Financial. Again, all of his information is linked in the show notes and description below. So reach out to your local advisor. If you're in York or Adams County, reach out to Travis specifically, and we will see you on the next show.